Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Alright, good evening to all the viewers of 202511. Hello, everyone. Today is Monday, November 3rd. We're going to discuss 2 topics today, as shown in the 2 titles. The first topic we'll talk about is the uncertainty surrounding the Federal Reserve. After the last meeting, the Fed made the decision to cut interest rates. But moving forward, we can observe the actions and thoughts of these officials, and also consider what they might do next. Alright, let's take a look. Hello to our viewers, online friends, and Alice. Hi, Anna. Yes, we're still getting used to the new schedule starting today. That's right, our 202511 program is now starting at 9 o'clock. Later on, because of daylight saving time, the US stock market will open at 10:30. So please make sure to pay special attention to that. Alright, so first, let's get into the first part of today's topic. Where does the uncertainty between the Federal Reserve and the market come from? Because, as we saw on Bloomberg, there's this Facebook. There's a chart showing the distribution of their policy stances, which we'll show you in a bit. Currently, within the FOMC, there are about 3 distinct directions or positions that members are supporting. There are those who lean more hawkish, those who are more dovish, and then some who are more neutral or whose positions aren't very clear right now. The divisions at the 2 extremes are the most obvious. For example, in terms of policy stance, the most hawkish members, like Logan or Harker, are more supportive of the idea that, going forward, perhaps, or in this upcoming December meeting, is it more likely that they'll maintain the current interest rates? Let's take a look at the next slide. On the other hand, if we're talking about a more dovish stance, then that's Stephen Milano. Because he has a closer relationship with Trump, he's actually more inclined to support Trump's position, which means lowering interest rates. Alright, let's take a look. Oh, a viewer named Caesar. Hey, hello, teacher. Hi, thank you so much for watching. Alright, as we mentioned, this chart here. This is based on the headlines from the news. After analyzing possibly hundreds of news articles, some of these officials have been interviewed or have expressed opinions on certain issues. So Bloomberg did a bit of analysis on their stances. So, in this recent situation, where exactly do they stand? First, we can see that in the middle is Chairman Powell, because last time he already said, and in his speech, he also mentioned a key point, which is, don't assume that in December, the outcome of this meeting, whether a rate cut is inevitable or certain, he said not to, and he tends to avoid sending that kind of message to the market. Of course, actually, the Fed chair, especially during his term, has never really committed to what the next policy decision will be, whether it will be a rate cut or staying the same. In fact, they always, and there is always some room for policy maneuvering or ambiguity, because even if he personally leans a certain way, he still has to go through the entire FOMC vote, or get agreement from other board members, or come to a comprehensive conclusion together. What gets expressed is the result of this decision, so it's not entirely up to him alone. Maybe he can guide the direction of the meeting's discussion, though. But still, he has to see what his other colleagues, the board members, decide regarding the outcome of the meeting. Alright, so on the right side, as we just mentioned, there are the more hawkish members, meaning those who relatively want to keep interest rates unchanged for now, not lowering them so quickly. On the left side, as we mentioned earlier, there's Milan, who is more closely associated with Trump and leans toward a dovish stance. That means in the upcoming December meeting, he might be even more inclined to push for another rate cut. Alright, let's take a look. So, as we just mentioned, it analyzed 567 news headlines. Using Bloomberg's original model, it marked that about 29% were more dovish and 20% were more hawkish. However, it went a step further to analyze that, since Miller tends to favor rate cuts, right? So if he makes more frequent statements, it could cause the proportion of dovish comments to increase a bit. So, if his frequent statements were reduced or removed, then the proportion of hawkish comments would slightly surpass the dovish ones. In other words, it would be 28% hawkish versus 24% dovish. So, there are some differing opinions in the middle. Alright, and then, we also see that according to Bloomberg standards, actually, even though Bloomberg believes that he is surrounded as the chair, and then at the press conference after the October meeting, his remarks were basically neutral, but considering that he made statements specifically about December, he was trying to manage the market's expectations. If the market keeps thinking, oh, there will be a rate cut in December, there will be a rate cut in December, then he might come out and say, actually, it's not that certain, it's not that clear-cut or definite, even though the market has actually already started to price in the expectation of a rate cut here, meaning the market more or less knows that this could happen. Of course, we know he won't say anything too definite or certain, and he won't make any clear promises. Right, it's not set in stone, it's just that the probability has increased a bit. So we look at this probability as maybe 60 to 70%, 70 to 80%, or 80 to 90%. So the idea is that the probability will be a bit higher than 50%, and you can think about it in that direction. Of course, we still have to leave room for another possibility. What is that? For example, going forward. On Wednesday, there will be the ADP employment report, which is from the private sector. Then on Friday, for the non-farm payrolls, it depends on whether the government has reopened. But at the moment, that doesn't seem very clear yet. If they refer to some of this employment data, these new changes, or if the inflation-related indicators show that inflation continues to move downward, heading toward the Fed's dual mandate targets, then maybe some of the board members who are relatively more hawkish and concerned about inflation might gradually shift toward a more neutral stance or even move toward a path where rate cuts become possible. Brother Urin, Coco Nomo, and online friends, hello to both of you. Next, let's take a look here. It mentions that Logan and Haima said on Friday that they are more inclined to keep interest rates unchanged, meaning they are not moving toward the path of rate cuts. So next, since it's about 6 weeks away, which is the December meeting, they think that more rate cuts will be needed going forward. Some of the Fed officials, since last time they already decided to cut rates, this means that among the majority who voted, they felt that a rate cut was appropriate in October. As for whether there will be another cut in December, that depends on what happens next with the job market and inflation, which we just mentioned and need to keep an eye on. Why these two? Well, because they are the two main mandates of the Federal Reserve, long-term price stability and maximum employment. So what they want to see is a balance between these two. Now, Logan mentioned that unless there is very clear evidence, this is the premise, showing that inflation is falling faster than expected, or that employment is starting to cool down and slow too quickly, then if the resilience isn't strong enough, or if people start to show less enthusiasm for employment, meaning it's not as hot as it was before, otherwise, he said it would be very difficult to cut rates again in December. So, everyone is tending to be more cautious, and their statements are more reserved. The chairman also mentioned that another rate cut in December is not a done deal, so they still have room to observe the data. And there are more and more voices suggesting that maybe it's time to pause. These voices are getting louder. People are speculating whether it will happen in October. Although most still think a rate cut is likely, there may be some who will vote to pause the rate cuts in December. This is something everyone should consider. Alright, so as we just mentioned, the two doves, Logan and Hammond, don't have voting rights on monetary policy this year, so they're only participating in the discussions. Now, whether the direction of their discussions and their opinions will influence the thinking of other board members going forward isn't certain. But at the beginning of next year, since there's only one meeting left this year, in December, next year, things will be different. It's possible that with the rotation, they will become voting members. So if their views don't change, then next year it's really hard to say what will happen. Although, in May next year, the Fed chair will also be replaced, since their term will be up. As for the candidates for the next term, there are currently a few contenders. Some of them have clearly expressed support for rate cuts, while others seem more inclined to maintain independence. Alright, let's take a look at Stephen Milano. He has dissented for the second time in a row, and this time he favors a larger rate cut of 0.5 percentage point, meaning he's leaning toward a two-step rate cut. Alright, let's take a closer look and see what his thoughts are. He believes that it's necessary to maintain a certain degree of restrictiveness, in other words, restrictive interest rates, in order to bring inflation back to target. So, what he's consistently considering is inflation. Compared to the previous phases of aggressive rate hikes in 2022, the points they're considering now are still the same. They're still focused on this situation. Now, I have to point something out here. Why was there such aggressive rate hiking in 2022? What was the reason for that? In the stage before that, the Federal Reserve had actually already been a bit late or had underestimated the inflation situation. So, that's why Trump called the Fed chair Mr. Delay. But here, I also want to speak a bit on behalf of Chairman Powell, or really, on behalf of their whole team. Although it does seem like they reacted a bit late, this actually has to do with their professional training or academic background. They often need to be more cautious, looking at all kinds of employment and inflation reports. In fact, many of them have master's or doctoral degrees related to economics, for example. This kind of training makes them more inclined to wait until they see definite data, like when inflation really starts to rise, before taking action. After that, they still have some tools to control inflation, because historically, raising interest rates has indeed been effective in curbing inflation. Of course, their approach is often aggressive rate hikes. So, the question is, did they misjudge this time? In other words, did they underestimate how quickly the job market would cool down? It's worth paying attention to whether they might repeat the same mistake as last time, underestimating inflation. This time, it's about underestimating the cooling of the job market. This is something to watch. Everyone should keep monitoring this, and first, we can start by looking at Wednesday's ADP numbers. Although private organizations aren't government entities, their data can still serve as a reference. Has the cooling in employment already gone too far? Or has it already exceeded what the Federal Reserve expected? These are things everyone can keep watching. On the other hand, ultimately, this supported the decision to cut rates. He said that even after the rate cut, the current monetary policy is still somewhat restrictive for the overall economy or inflation. Alright, let's take another look. So, what about internationally? What are the major news and investment trends? Actually, the White House announced that China will suspend additional export controls on rare earth metals. This is according to the White House. The White House said that under the agreement, China will issue some general licenses for rare earths, allowing them to export. So who does this benefit? Of course, they're talking about domestic, meaning American end users, as well as their suppliers around the world. Because this is very important for American business interests, that's why they would say something like this. That's what he said. And this is actually an agreement that was reached after the Trump-Xi meeting, so he treats it as a kind of political achievement to promote. He wants to tell everyone that, actually, when it comes to dealing with China, no matter what kind of engagement, he has his own way of handling things. Alright, so as for China and the US, both sides had previously stated that Beijing would implement an enhanced version of the control measures that caused some turbulence back in October, specifically, the control measures on rare earths. First, the suspension will last for 1 year. But here's something for everyone to think about. Right now, Beijing is planning to pause for a year, right? That means during this year, both China and the US are essentially trying to buy themselves some time. What kind of time are they trying to buy? On China's side, they're hoping to gain time to, for example, develop advanced chip technology and other tech advancements. As for the US, they're hoping to use this year to build up a supply chain for rare earths that doesn't rely on China, as well as to secure mineral resources, develop refining capabilities, and improve downstream processing. If they can achieve these things within this year, if they can buy themselves this kind of time, then even if China still holds a dominant position, the US can at least slightly reduce its dependence on China for rare earth materials and related supply chains. This would give them more room to maneuver and compete with China in the future. In other words, as we'll see on the next page, this is indeed the case. The United States is actually constantly on guard against China, and it's also rallying its allies in Asia. That's why Trump, for example, visited various places in Asia, whether to seek support or to offer some backing. Actually, the alliance between the US and its partners is based on mutual equality. For example, he said that the US and South Korea are united as one. In this context, it helped ease South Korea's concerns about the $350 billion investment commitment. Oh, of course he will. Trump will say some nice-sounding things, or maybe he really does think that way, because right now he probably really needs South Korea. Or, for example, when he talked about Japan's new Prime Minister Sanai Takaichi, he mentioned this as well. Takaichi is also open to Trump seeking any kind of help, meaning she's leaving the door wide open. She hopes that the US and Japan can work together and cooperate with each other. Because, actually, in earlier years, Japan was in China. For example, when it comes to territorial or trade disputes, Japan has actually suffered losses from China regarding rare earths. That's why Japan has developed some rare earth technologies, or rather, technologies for mining and processing rare earths. So, the US is also preparing to cooperate with Japan in this area. Alright, let's take a look at the next part. But this is more like the perspective from the Chinese side. For example, the economist Li Daokue, because he often gives advice and suggestions to the Chinese government, like sharing his thoughts and strategies, he usually expresses views that are more aligned with China's stance. So everyone can pay attention to and consider how their perspective looks at things. He said that China is being treated as an equal partner by the United States. Since he once served as an advisor to China's central bank, he tends to look at things from the Chinese perspective, so you can take that as a reference. He mentioned the Trump-Xi meeting. He said that, historically or at this historic moment, the most important development for both sides is that the United States recognizes China as an equal dialogue partner. Actually, that's correct. On the side, because actually both sides have their own strategic needs. As we just mentioned, whether it's about buying time to develop advanced chip technology in China, or the US seeking to reduce its dependence on China's supply of rare earths, or its reliance on them. So maybe people might think that, for the US, its former status as the world superpower, now, is it becoming more of an equal footing with China? In other words, is China starting to rise to a level where it can stand shoulder to shoulder with the US? Actually, you can pay attention to this and think about it. Is it really the case? Maybe in some areas, there are still some gaps. For example, when we talk about technological development or the military, but it's undeniable that in certain aspects, China's influence in certain fields has slightly increased. Alright, let's take a look. As for the indexes, last Friday the Dow Jones Index was actually fluctuating at a relatively high level, because since the low point in April, or since the recent lows. Actually, it's been gradually rising in a rather steady way, mainly due to better-than-expected earnings reports, which have driven up the Dow Jones Index. Last week, the increase was 0.09%. Alright, as for the S&P 500, it rose by 0.26%, which is relatively a bit stronger, with a slightly higher increase. Now, let's take a look at the tech innovation sector, specifically the Nasdaq 100, or NDX. Its gain was 0.48%. Actually, ever since hitting a new high one trading day ago, it's been consolidating a bit at these high levels. Alright, let's move on to today's second topic, which is tracking some news about leading tech stocks and developments in the industry. Here, the video specifically mentions the ongoing issue with Tesla's unique door handles. The United States Auto Safety Regulator has officially stated that they have received a significant number of complaints from consumers regarding this particular defect in the vehicle's design. Because of an issue with Tesla's battery, people aren't able to get in and out of their Teslas smoothly. In other words, there's a problem with the door handles, so they can't be used properly. For example, a Model Y owner mentioned that the exterior door handle doesn't work as it should, which sometimes results in children getting locked inside the car. That is, the child is inside, the door is closed, and the handle can't be opened. At that point, there's nothing you can do except quickly seek emergency help, either by breaking the door or finding a way to get assistance from the fire department to open the car door. Otherwise, if it's a high-temperature situation, it could be dangerous for children or any passengers locked inside. So this is one situation that shows that break time equals 0.5s/. Even though technology continues to advance, sometimes these advanced products can still unexpectedly run into unexpected problems. Alright, now let's take a look at former US President Trump. He said that the United States will not share its most advanced chips with China. On the other hand, Microsoft CEO Satya Nadella also stated. Now, actually, he said that the main bottleneck for the growth of artificial intelligence is gradually no longer the supply of GPUs, but rather electricity and infrastructure. In other words, the lack of data center infrastructure. What he means is, you have to build these data centers, and after they're built, you need to fill them with equipment that can house all these GPUs. Alright, so for this kind of infrastructure, whether it's the power supply or ensuring that the GPUs can operate smoothly, how do you make it sufficient? Because he mentioned that this shortage of infrastructure is affecting the growth of Microsoft's cloud business. And he also said that his Azure cloud platform could have grown even faster. In other words, what he calls computing power is currently an obstacle for him. But computing power isn't just about the number of GPUs, even though that's what's being mentioned. It's limited by the physical infrastructure, not just the issue of chips, not just a matter of GPUs like that. Also, we mentioned Amazon, which also released its earnings report last week. It, together with the Korean semiconductor company SK Hynix, is exploring areas including next-generation technologies including chips. For example, intelligent agents related to artificial intelligence can actually take many forms, whether it's a smartphone, a laptop, or even an additional device, like Amazon's own smart home assistant. All of these are possible. It can develop into any form, but the main point is to make good use of AI technology to help Amazon's users, whether it's for shopping or for other services related to Amazon. In addition, let's mention something brought up by Hannah, a writer for the Wall Street Journal. When we talk about the performance of tech stocks, what lessons and experiences does this hold for investors? What can we learn from it? He said, in the field of artificial intelligence, we're talking about those big companies, the major tech giants. The results are mixed, because recently there have been earnings reports, right? He said Amazon's strong performance is driving the Nasdaq to rise for the 7th consecutive month as of Friday, setting the longest winning streak since 2018. Previously, as for Microsoft and Meta, because their spending plans, especially capital expenditures, are quite large, right? Investors might not be too keen on that, so there was some selling pressure, especially for Meta, whose drop was more pronounced. He mentioned that over $200 billion was wiped out in a single trading day. But is it really that serious? We'll discuss that a bit later. Leading tech companies have invested hundreds of billions of dollars in artificial intelligence. Next year, this spending will be even greater. In other words, this is essentially a competition among tech companies, whether it's about computing power or capital expenditures on equipment. It's a bit like an arms race. No one wants to fall behind, be eliminated, or be marginalized in this competition. So here, Meta, Alphabet, Microsoft, and Amazon, these 4 companies, have already told investors that next year, they plan to further increase their spending in this area. Now, this actually brings up a question. With such massive spending, is it because their CEOs or boards of directors have seen something that makes them willing to spend so boldly and on such a grand scale, pouring so much money into these enormous costs? Recently, there have been some debates about the possibility of an AI bubble. First of all, Jensen Huang has tried to downplay these concerns, but that's because he's one of the tech company leaders right in the middle of all this. As a leader, of course he's going to do his best to explain the situation in this way. Of course, whether or not you agree is up to investors to decide for themselves. But what we want to point out here is, first, we can consider that these boards of directors and CEOs have, to some extent, experienced the previous so-called dot-com bubble. That is, the tech stock bubble. So when it comes to this situation, they are somewhat cautious. So what was the situation back then? At that time, as long as a company had .com in its name, no matter if it was something like XXX.com or any kind of internet company, they all started to flourish. Their stock prices would rise even if they had no revenue or barely any profit, almost none at all, and yet the prices kept going up. Their P/E ratios and valuations reached ridiculous levels, which eventually led to the bursting of the bubble. But now, let's think about something. These days, there are actually very few companies in the world that can develop AI technology and make such massive capital investments in AI. We're probably talking about fewer than 50, or at most 100 companies worldwide. That's probably a pretty reasonable estimate, because first you have to buy so many CPUs, and then you also need to have so much top talent. This is the threshold that brand new startups just can't cross right from the beginning. Right. It's not like before, where you just registered a domain or had some basic stuff, like you built a website and could start growing your business. In the AI era, things might be a bit different from the previous dot-com bubble, because the barrier to entry is a bit higher now. Okay, So what some investors are worried about is that it's still unclear what kind of returns these investments will start to generate. Of course, if you compare these investments to the current revenue, since revenue is it the monthly revenue you can see every month? But investment is for the future, right? Yes, of course. With investments, you still don't know when they'll start to pay off. That's very clear. But at the very least, these big companies, for now, seem to still be maintaining, relatively speaking, pretty solid revenue, and they also have profits to support it. In other words, these companies that can afford to play in the AI race, whether it's computing power or this tech arms race, right now, it seems like they can not only strengthen their core business. Another thing is, it needs to prevent newcomers from using these kinds of advantages to replace or weaken it. For example, if GPT or others start investing, let's say they invest in a new search engine, for instance, that could potentially eat into some of Google's original core revenue areas, right? Next, we have to see whether this impact will be big or small. But since OpenAI itself has already developed quite a bit, even though it hasn't gone public yet. But among the many tech companies out there, it's also a company that deserves a lot of attention. So, in fact, it's already become a tech giant even though it hasn't gone public yet. Alright, let's take a look here. There's a mention of AI companies and the tech bubble from 20 years ago. There's a difference between the internet bubble and now. As just mentioned, they're making money hand over fist, and that's pointed out here. Meta, along with others, announced record-breaking revenue last week. In other words, they've invested so much capital, so much money, into AI. They've poured a huge amount of resources into this. And in terms of revenue, it does seem like they're seeing some returns right now. Alright, let's take a look at some of the concerns as well. Let's keep things balanced. So, what are some of these concerns? These companies, Meta, Alphabet, Microsoft, Apple, and Amazon, over the past 12 months, their accumulated cash flow has actually declined a bit. And this is important because cash flow is a crucial factor for a company's development. Having enough cash flow is essential, whether it's for future financing or for launching new spending and investment plans. Things will go more smoothly. Otherwise, it'll be just like some people in the market are worried about. They're announcing such large amounts of capital expenditures, but where is the money going to come from? This is something investors are definitely paying attention to. Alright, let's take a look at some other aspects. Tech stocks. What about South Korean tech stocks? On Monday, they went up, continuing the momentum from last week when Nvidia made some AI-related deals with them. Leading the gains were SK Hynix and companies related to semiconductors. Nvidia said it would collaborate in various sectors across South Korea, such as data centers, smart factories, autonomous vehicles, and robotics. In total, they plan to deploy $260,000 worth of Blackwell chips, which, of course, are from Nvidia. So, in South Korea, they're actually taking the initiative to negotiate and collaborate further with Nvidia, and they're also planning to set up many local data centers and smart factories. Alright, let's take another look. Since we've mentioned Nvidia, we can't not talk about its past. Over the past 2 or 3 years, its stock price has performed remarkably compared to before, so in this chart, what do we see? The blue represents the total market capitalization of the Dutch stock market, the yellow is Spain, and the green is UAE. Wait, what is this? Italy. And this white line here shows Nvidia's market capitalization over time. So we can see that actually, 2023, 2024, and 2025 each represent different turning points. For example, in 2023, Nvidia's market cap was about a quarter of these 4 companies combined. The combined market capitalization of these countries' stocks might have only accounted for a quarter of Nvidia's value, but by 2024, it was getting close to half. Alright, by 2025, it reached 70 to 80%, and by the end of the year, since 2025 here is the beginning of the year, right? Now it's already almost the end of the year, October or November, and Nvidia's market cap has already surpassed the total market capitalization of these 4 countries' stocks combined. Now, this chart alone is simply meant to show that, of course, using a single company to compare its market cap growth with the total stock market capitalization of other countries is, to some extent, a bit unfair. Why is that? because the stock market capitalization of these countries comes from different companies and different businesses accumulated together. If a single company is experiencing rapid growth, then of course its stock price and market cap can indeed grow faster than those of entire countries. But this just reflects one situation, that is, indeed in the past, and certainly in the coming years, this company is worth paying attention to. Whether in the capital market or the stock market, its development and growth rate have truly been remarkable. Alright, let's take another look. So last Friday, it was also fluctuating at a high level. After hitting a new high, it consolidated a bit. Next, we need to pay attention to its business model and whether the market still has doubts about its capital expenditures, or if, after Jensen Huang's remarks at the GTC conference, the concerns about the AI bubble have gradually been downplayed. After this situation, maybe the market will feel a bit more at ease. Alright, let's take a look at the international situation. Here, it's mentioned that the UK government has recently supplied Ukraine with more Storm Shadow missiles. Whether you call it Storm Shadow or cruise missiles, the hope is that Kiev, which is the capital of Ukraine, will be able to carry out long-range strikes inside Russian territory. In addition, the UK is also concerned that Russia might intensify its attacks on Ukrainian civilians during the winter. So the UK and its relevant NATO allies actually hope to express and increase Western support for Ukraine. In other words, whether it's in terms of armaments or various types of military resources. Although the United States tends to prefer a transactional approach, in other words, if Europe is lacking certain armaments, they can purchase them from American arms manufacturers or defense companies. After making the purchase, they can then decide whether to donate them to Ukraine or to support Ukraine by sending trained military personnel. Alright, next we can see that SHLD is an ETF related to the military and defense sector. Last week, it had a gain of 0.9%. So, looking at this kind of asset, we can see that its main components, the top two holdings, actually include Iran, which is also very well known, whether it's related to artificial intelligence or companies that collaborate with the defense sector. The second one is Raytheon Technologies, which is also a well-known US defense stock. So everyone can continue to keep an eye on the performance of defense-related stocks and individual companies in the market going forward. As for the issue of the US government shutdown, it's actually relatively. Now the situation has become quite tense. Because as mentioned, if the government shutdown this week still can't be resolved, it will become the longest one in history. Previously, it lasted about 35 days, and this time it's already getting close to that. Okay, he mentioned that millions of people will lose food assistance, and healthcare subsidies will expire. So, as of now, there's still no solution between the two parties to end this shutdown. In other words, this is actually a cycle. As for Trump, he says the government should reopen first, and then talk to the Democrats. But the Democrats say they want to negotiate first, and then decide whether to vote to reopen the government. Alright. So to put it simply, this part mentions that the Democrats are demanding negotiations on subsidies for the Affordable Care Act. Here, you can see that Senate Democrats have already voted 13 times against reopening the government, which means their stance is very firm. They insist on keeping the government shut down first, to force Trump to come to the table and negotiate with them. So what about Trump? On the other side, Trump is telling these Republican lawmakers that the Democrats must first agree to negotiate with them, and only after reopening the government can they talk. So, both sides are actually holding firm positions, and this has created a deadlock that hasn't been resolved yet, so there's no way to say when the government will reopen. As for where the pressure will fall, well, actually, it depends on which side. In the case of the United States, for example, we've seen some air traffic control issues, like flight delays and similar situations, which have led to a lot of complaints from local residents. They might feel that, since the country is currently under a presidential system with the Republican Party and Trump in power, it's more likely that this wave of dissatisfaction will be directed at Trump, or people will be more likely to see it as Trump's responsibility. So in the end, it might be that Republican lawmakers and Trump himself will bear more of the blame and pressure. Of course, right now Trump is still maintaining a tough stance, But if we wait a few more weeks or months, that might change. Alright, let's take a look at the international economic situation. An official from the European Central Bank said that we need to stay alert to the persistent risk of inflation. Since winter is approaching, they mentioned energy costs and potential price pressures, which make them realize there could be some upward risks for inflation right now. Alright, next let's take a look at how tech stocks are performing. Amazon's gains last Friday were about 9.58%, which is actually pretty good on the overall chart. Among the major tech giants, it's one of the better performers. Although it looks like after the rise there's been a bit of a pullback, that's actually a reasonable phenomenon. So what should we pay attention to going forward? Mainly, we should watch how it performs after the earnings report, since the earnings themselves were quite good. It even mentions some key points, like the market will continue to buy in, so the main thing to watch is whether the buying momentum can be sustained going forward. That's something worth keeping an eye on. Here, we're looking at NSFTR, Microsoft. As for Microsoft, there was news today that they signed a $9.7 billion deal. And which company is this with? IRN. They're purchasing some AI cloud computing capabilities. Last week, their stock price was a bit on the weaker side, but overall, there haven't been any major issues so far. They're still continuing to invest in artificial intelligence. They're also continuing to strengthen and consolidate their own advantages, both in terms of technology and user base. Alright, so this week, there are some important financial events and data to keep an eye on. For example, the ISM Manufacturing Index, Wednesday's ADP employment numbers, and on Friday, the non-farm payrolls and unemployment rate. Because the government still isn't sure it can reopen. If not, there could be more delays. There's also the University of Michigan Consumer Sentiment Index. Next, let's see which companies report earnings this week. After the market closes, after hours today, so early tomorrow morning. There will be Panther, which I just mentioned, an important company in the military AI sector. Then there's AMD and Uber on Tuesday. On Wednesday, we'll have McDonald's, and on Thursday, there will be Li Auto, as well as Qualcomm and ARM. On Friday, it's more related to the rare earth sector, with MP, the American rare earth manufacturer. Now let's take a look at the pre-market ups and downs in the US stock market. In the past, I usually showed the ups and downs within the S&P 500 index, but today I'm taking a broader view to see if there are any others. What about some of the relatively smaller companies? Of course, I still set some market cap standards so everyone can take a look. The iron I just mentioned, for example, is up 14%, and then there's Micron, which is up a little over 4% in pre-market trading. Alright, then there's a biotech company called ALVO, which is down in pre-market trading. Let's briefly talk about the reason for that. So, ALVO is a biotech company, and its main focus is on developing certain products. For example, pre-filled syringes and auto-injectors. So, regarding this project, since they want to get FDA approval, it's a type of medical device and pharmaceutical product that can be used to treat arthritis. He mentioned that regarding the application for AVT05, the FDA has also responded to them. The response stated that the company must address certain issues related to the manufacturing process. Only after that can they possibly obtain full approval. So, as a result of this, they have lowered their 2025 revenue forecast from the previous $600 to $700 million down to $570 to $600 million. In other words, this could have some impact on their revenue, and relatively speaking, it's not exactly a positive one. That's why the drop in their pre-market stock price is a bit more significant. Now, let's take a look at what I just mentioned about Microsoft signing an agreement with them. It's a multi-year contract for CPU cloud services. According to this agreement, IREN will provide Microsoft with usage rights for the GB300 related to FADA over 5 years, with a total value of $9.7 billion, which is actually quite a lot. That's not a small amount either. They also reached an agreement with Dell Technologies to purchase GPUs and related supporting equipment for about $5.8 billion. Alright, so this is what I mentioned earlier about the US stock market before the opening bell. This stock was up by more than 4% pre-market, and the numbers kept changing. The reason is that this company released a lot of updates last week, especially We can see that in South Korea, it seems to be related to memory chips. They have an optimistic outlook for the entire memory chips sector. In fact, some investment institutions have even analyzed that the memory industry might be entering a super cycle. So, if you currently hold or have positions in assets related to memory chips, or if you want to invest in them in the future, you can use this as a reference. Whether you want to search for additional industry information or look up financial reports for individual stocks, this could be helpful for you. After all, when it comes to something as important as investing, sometimes doing your own research and taking matters into your own hands can lead to a more satisfying outcome. Alright, that's all for today's session. Thank you all so much for watching, and I wish you successful investments and plenty of profits. This is Kung Guangan. See you next time.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.